Hi, I would like to introduce Andrew Campbell. Andrew is a director of Latin American equities for CSFB, Credit Suisse, as a matter of fact. He's responsible for LATAM equity strategies and research coverage. He initially was sort of a ranked analyst, a top-ranked analyst in the telecom media sector. And he's now sort of like presenting here the developments that they are doing in Brazil. Important also to say he has an MBA from University of Chicago. So welcome, please, Andrew. Thank you.
Great. Thanks, Amaury. Thank you, Terrapin. Thanks, everybody, for joining today. I think that one of these years we have to figure out how to do this event up on the roof, up at the Sky Bar, because you can get one of the best views in São Paulo that way. What I'd like to do is, after these two excellent presentations from Amaury and Ilan on some of the structural, longer-term themes in Brazil, I'd like to take this down to perhaps a more actionable or tangible level and talk about the Brazilian stock market and what our outlook is for asset allocation in a Latin American context on a per-sector basis, and gathering together the recommendations from Credit Suisse's research team highlight what we think at this time are some of the best ideas in the Brazilian stock market. If I could I'll just preface that by saying that we believe very much in the medium and long-term outlook of the Brazilian economy as well as the Brazilian stock market. Everything that Ilan highlighted with the expanding middle class in Brazil, the increasing purchasing power of the middle class, as well the export growth story. We believe very much in all of those drivers for the economy and for the stock market. At the same time, though, we see some headwinds that could make this a choppy period for Brazilian equities. And if you've been invested in the stock market this year, you're probably, in local currency terms, down 5 or 6%. The real has appreciated by more or less the same amount. So you're more or less break even, which is not a very satisfying outcome for an equity investor. What we think is that the next few months there will continue to be some headwinds, but we do see some pockets of opportunity. So let's jump into the presentation. Well, first of all, if I could maybe just explain a little bit of the global outlook from Credit Suisse's global equity and fixed income strategists. We are a bit cautious globally on equities. In fact, our global equity strategist, Andrew Garthwaite, he reduced our weighting in equities from an overweight to a benchmark weight about 2 weeks ago. He also reduced emerging markets from a 25% overweight to a 10% overweight. So we continue to think that equities for emerging markets can outperform developed markets, but we have less conviction on that point at this moment. One of the reasons is because you'll see on the top chart that leading indicators in developed economies have now rolled over, which means that global growth is no longer accelerating. Economies are still growing, but not at the same pace that they were previously. We also look at earnings revisions, for example, on a global basis, and analysts globally have now been bringing earnings estimates down, in fact, moving into negative territory. Normally, when you get a mix of leading indicators rolling over and earnings revisions turning negative, it's normally not a great outlook for equities. Then we layer on top of that for emerging markets, of course, the inflation issues, and it's understandable why we may be in a bit of a soft patch for the next few months. Now, another point is that we're, of course, coming close to the end of QE2 at the end of June. Our macro folks had thought that maybe there would be a QE3 or that there would be a phase-out of QE2. Now it seems that there will be a hard stop, so it's going to be cold turkey. About a year ago, when QE1 ended, the Latin markets corrected by about 17%. Now, granted, there were other things going on in the world. Of course, there was the Greek debt crisis. There were various other factors at that time. But we think that one of the elements was probably the end of QE1. And as we head to the end of QE2, I can tell you that our base case scenario is basically that there will not be a major disruption of any kind in the capital markets, and in fact that U.S. Treasury rates will stay at a similar level to where they are, that the U.S. dollar will continue weak, but we have to acknowledge that this is more of a risk than anything else. I think that the best case scenario is that there's basically no change, and that the risk is that we would see some move up anyway in U.S. Treasury rates, which for a market like Brazil with a current account deficit and a currency which on many measures appears overvalued, we would see that really more as a risk factor. So let's talk a little bit about Brazil more specifically. In the LATAM portfolio that we recommend a little over a month ago, we reduced Brazil from an overweight to a market weight position. We raised Mexico from an underweight to a market weight. A lot of this is not just because of the global backdrop, but also because of the inflation scenario. And Brazil has an output gap. What this means is that the economy has grown faster than potential GDP. Last year, GDP growth was 7.5%. Brazil doesn't really have the level of investments to support that degree of growth without creating some bottlenecks in the economy. Bottlenecks that are pretty easy to see if you just spend a few days trying to get around São Paulo. So the answer to this is that the economy has to grow slower, that there needs to be a policy response to address inflation. And if you see the chart on the right-hand side, initially inflation was more or less contained to food and to commodities categories. What has become a bit more concerning is that in March and April, you've seen a transmission of that inflation into non-food categories. So here you see basically services inflation, which has accelerated, non-food inflation, as well as administered prices. Now, the interesting thing is that the policy response has been a bit confusing, I would say, in the sense that the central bank actually has slowed the pace of tightening. So whereas they had been increasing by 50 basis points per meeting, they actually only increased by 25 basis points at the April meeting. And the expectation from my macro team is that there will be 2 more increases of 25 basis points at the next 2 meetings. But the problem is that we're not fully convinced that this will be sufficient to put inflation back on a downward trend to converge back towards the 4.5%, which is the center of the central bank's range. So what that is potentially setting up for later this year, at the end of this year or the start of next year, would then be an additional tightening or a more aggressive tightening scenario, which would require slowing the economy even more. So that's the concern that we have on inflation. And the last time that we had an inflation spike in Brazil was in 2002, 2003. And, of course, equities were at a very low level at that time. We think that around 7 or 8% inflation is the level, based on some studies we've done in other emerging markets, that's around a level where you tend to get some derating in multiples for the equities market. So inflation now is at 6.3%. It seems that it's going to go above the high end of the central bank's range, which is 6.5%, perhaps stay there for a period of several months. And a little bit of inflation can be good for equities. More inflation would not. What's interesting about this now is to contrast this to Mexico, for example. I mean, if you're a Latin American investor, you're probably looking principally at Brazil and Mexico. In Brazil, growth numbers have been coming down. Inflation numbers have been going up. In Mexico, growth numbers have been going up, but actually inflation has stayed the same or even come down a little bit. And the reason is because the Mexican economy was hit so hard during the crisis that there's excess capacity in the economy. That unemployment, which in Brazil is at historically low rates, in Mexico it's actually still below the levels that it was, or sorry, above the levels that it was pre-crisis. And you can see that the inflation levels, we're expecting 3.7% inflation for this year. Economists think that in Mexico there probably won't really be any tightening this year, certainly not during the summer months. At the most you could have, say, 25 basis points of tightening in December of this year. So I suppose that the question in that case would be, why aren't we just outright underweight Brazil in our model portfolio and overweight Mexico. And the reason is valuations. Because in Mexico, you're really paying for an expensive market there. If we look on a forward PE basis, Mexico's trading at about 17 times. That's actually more than one standard deviation above the 5-year historical multiple. And Brazil is trading at 10 times forward PE, which is more or less in line with where Brazil has traded. So the dilemma for Latin investors is that Brazil is a cheap market with a lot of macro headwinds, perhaps for the next few months. Mexico has a very favorable macro backdrop, but at an expensive valuation. So the answer for us is that we would hold both markets essentially at market weight. This is just another metric really to show how Brazil looks less expensive than the other LATAM markets. What we're doing is basically taking price to book across the bottom axis, and we're comparing levels of price to book with the levels of return on equity for the specific markets. And the idea being that you can justify higher levels of price to book if ROEs are higher. And what we see is that Brazil, Mexico, and Chile, the markets all have return on equity of about 15%. But the difference is that Mexico and Chile trade at a price to book that's more than 2.5 times. Brazil trades at a price to book that's more like 1.5 times. So again, Brazil is an inexpensive market. So we could just talk now a little bit about sector positioning and what to own in the Brazilian market. And here we're showing the breakdown of PEs on a sector basis and also earnings growth on a per sector basis. We basically have two big overweight sectors in our model portfolio right now. One of them is domestic defensives, which we define broadly as telcos, utilities, healthcare, education. And our other big overweight sector would be mining, which is essentially Vale. Now, if you look on a PE basis, mining is the least expensive sector on the Ibovespa. It's basically at a 6 times PE, yet with the highest earnings growth. That the telcos and utilities trade around 10 times, more or less the market average. Consumer sectors such as staples and discretionary are actually trading at about 25 times. So even though we would like to have consumer staples in our portfolio, and we see them as a more defensive sector, they're expensive. So the preference would be more, as I said, the telcos, utilities, healthcare, and education on the defensive sectors. And if we look at the experience after QE1, when QE1 ended, in fact, defensives outperformed domestic cyclicals. And we think that after the end of QE2, it's possible that the same will happen again. One of the dilemmas that we face is with the Brazilian banks, because banks are cheap, like defensive sectors that don't grow, but at the same time, they have very good earnings growth in the 15 to 20% range. Banks is a sector that we would actually be a bit overweight in spite of being more of a domestic cyclical sector. I'll just talk for a moment about equity supply and flows into the Brazilian market. One headwind that we don't expect to have this year is an excess of equity supply. And if you see 2010, of course, there was the massive offering from Petrobras, which was over 40 billion reais that was placed into the market. We don't see any huge transactions coming to the market such as that this year. If you look at the first quarter, equity issuances were about 5 billion reais, more or less. We think that on a full year basis, you'll probably see good IPO activity, but really concentrated more in smaller transactions, as we've seen so far. So on a full year basis, perhaps it will look more like 2010 on an ex-Petrobras basis, but we don't really see equity supply as being a key risk factor for the market this year. Okay, now just drilling down now to the level of specific stock recommendations. As we talk about inflation, there are certain sectors which are very good inflation hedge type sectors. For example, electric utilities. Perhaps the best possible inflation hedge would be a hydro generator. You know, most of the power production in Brazil is hydro. The hydro generators in many cases have their tariffs indexed to inflation, but they essentially have no operating cost because their only operating cost is really water. So we like the utilities sector, not so much on the distribution side where they're going through a tariff review process, but with the integrated and the hydro generators. Our top idea actually in the utility space now is Simigi. That's the integrated operator, the state operator from Minas Gerais. It's a company that's made a number of acquisitions. We feel that some of the risks on the M&A side have actually diminished, that after several years without much earnings growth, we think that the earnings prospects have improved. We have a big weighting in Simigi in our model portfolio. Another company that we like quite a lot is OHL Brazil, which is a toll road operator, linked to increasing traffic volumes, but with somewhat of an inflation hedge because the tolls are linked to inflation, very low operating costs. Most of their costs are really capex that come through the depreciation line, but not really a pinch on the cost side. Another sector is the properties sector, essentially malls, property owners that are basically leasing properties and have their leases adjusted up by inflation. The problem with those real estate names is that they've already moved a lot for this year. So the top names that we would highlight as inflation hedge type stocks are really Simigi and OHL Brazil. Of course, we heard this morning a lot about Brazil's growth as a commodities exporter. And in fact, Credit Suisse is looking for about a 25% increase in exports this year in US dollar terms. And if you're looking to play that theme, we think that Vale is by far the best option. Of course, iron ore is Brazil's biggest export. And our house view is that although Chinese growth may have slowed a bit, our macro team took growth down from 9.1% to 8.8%. Growth around 9% is still very conducive to very strong demand for commodities, including iron ore. We think that there is a particular balance in the iron ore market in terms of supply-demand that makes this a special commodity. Price per ton is about $180. We think it could go up to around $200 over the short term here as we're through the spring kind of construction season in China. And Vale specifically has been, here we're just highlighting that about 85% of their revenues are through exports. Vale specifically has been punished because of concerns about political interference in the company. I'm sure you guys have all seen that they've changed over their CEO. We think that now that that change has taken place, probably now the political noise is going to die down. People will focus more on the fundamentals, and Vale is a stock that's trading at only 6 times PE. So we have a very heavy weighting in our model portfolio in Vale. I mentioned the banks as well. We do have a favorable view on the banks. One of the things we show here on the left is the debt service ratio. There are a lot of questions about whether or not Brazil is headed for a consumer debt crisis. We think that it's not. In fact, people look at the debt service ratio, which is over 20% of income being allocated to principal and interest payments over the next year. The thing is that that ratio has actually been stable over the past few years. So credit growth has been very strong, but wage growth in the wage bill has also been very strong. And as a result, we also have to point out that within the debt service ratio, it includes all principal. And in Brazil, people don't really borrow with tenor. So as a result, they're borrowing all on a short term. All of that short-term debt basically comes in through the debt service ratio. But we think that based on NPL ratios on the debt service ratio, that banks are not headed for any kind of a consumer loan crisis. In addition to that, we're still seeing credit growth in the 15 to 20% range in banks that are trading at about 9 times PE. Another sector with a very strong structural growth story in Brazil that has an element of this defensive posture that we're looking for is healthcare. And in Brazil, as we see people moving from Class D and E into Class C, one of the first things that they want is a private healthcare plan. Part of that's because the government actually spends very little on healthcare. The public healthcare system is very poor. and only about a quarter of the population now has a private healthcare plan. We think that that's going to continue to increase. There's one company in particular called Amil that we're very favorable on. They're the largest private healthcare insurer in Brazil, and that's a name that we would recommend as a vehicle to play that theme. On the other hand, on oil and gas, we are actually underweight. And so Petrobras, we're underweight. The house view on oil is very different from what I discussed on iron ore. We think that the oil price has about $20 of political risk priced into it. That as things calm down in Libya, we don't see really much interruption coming from the other countries. We think that the likelihood is that the oil price is going to come down rather than to go up. And on top of that, Petrobras has some very specific issues. As Almari and Ilan mentioned, there will be a very strong investment in pre-salt, but the problem is that Petrobras does not really generate cash for the next 10 years. And you can imagine what that does on a DCF basis to not really have any cash flow until way out in 10 years. We also think that there's the likelihood that they'll miss some of their production targets this year, and our analyst feels that even if they meet all of their production targets, that you'd still be looking at a quite expensive stock. So if I were to summarize our model portfolio, I realize that you may not be able to read this table, but essentially what you would see is that we're a bit overweight the banks, essentially all three of the big banks in Brazil, Itaú, Bradesco, Banco do Brasil. We're overweight utilities, in particular CEMIG. As I said, we're overweight telcos. In that case, our top pick would be Telesp Vivo, which is the Telefónica subsidiary, the largest mobile operator in Brazil. We would not really have exposure to airlines. We would be very underweight domestic cyclical sectors, which would include consumer discretionary type names and also real estate, where they're on the front line really for cost pressure and some of the inflation pressures that we're seeing. And on the other hand, we would be strongly overweight in Vale, which is a cyclical, but it's not a domestic cyclical. It's really more linked into Chinese growth. And then we have a couple of logistics companies that we like, which would include OHL Brazil, the toll road company, and Santos Brazil, which runs the biggest port in Brazil. So this is more or less a summary of our outlook on the Brazilian market. We're basically positioned in a more defensive portfolio, also with exposure to mining. What we'll be looking for over the next few months is some kind of clear and visible peak in inflation. We're not that optimistic that we'll see that without another more aggressive tightening cycle, but that's really the catalyst that we'd be looking for the Brazilian market. We're looking for a very clear peak in inflation. We think that would be the signal to rotate back from more defensive names into domestic cyclical names. So that wraps up my presentation. Thank you very much for your time, and enjoy the rest of your meetings today.